Hi, everyone. My name is Matt Brown, and welcome to the Direct Private Investment Show. With me in the studio is Bruce Smith.
Hello, Matt.
Bruce, welcome to the show. And with us on the line is none other than Josh Greene. Josh, welcome to the show.
Thank you. Excited to be here.
Likewise. And so today, guys, we're going to be talking to you about really understanding the investment risk associated with specifically direct private investments. So, Bruce, I'd like to start with you.
Sure.
Why don't you kick us off and just give us the context for risks as it relates to direct private investment? What do they look like? Do they fall into particular buckets? What do we need to know?
Oh, sure, Matt. That's a great place to start. There are really investment risks, industry risks, management risks, and offering-related risks.
All right. So we're going to double click down on some of these. Josh, I'd love to start with you. When it comes to investment-related risks, what comes to mind for you as it relates to helping investors understand what investment-related risks can look like?
Sure. Everyone has different risk tolerances, and it's really important for investors to figure out what risks they can tolerate and what they can't. We help with identifying the risks and then let them make the decision if they're risks that they deem tolerable. One of which that we spend a lot of time on is economic condition risk. So, one very topical example is the Fed raising rates. They've done so, more than a handful of times to the highest rates have been in over a decade. And because of that, different investments like real estate, where people are borrowing money to earn rent rates in a multifamily property, that spread is getting tighter. And because of that, the deal is getting riskier for real estate properties to meet their objectives. Also, companies buying equipment, CapEx, whatever the case is, banks are less likely to lend to them. And if they do, they have to earn more of a return on those assets to repay those loans.
Fantastic. Bruce, over to you. I'd like for you to talk about investment-specific risks. So, for instance, if you think about the secondary market, for instance, and this idea of liquidity, for example, that's one example of a investment-related risk. Walk us through, from your point of view, having done hundreds, if not thousands, of these deals or being involved in them, and looking at the risks associated with these investments. From your perspective, Bruce, walk us through what our investment community needs to know.
Well, you touched on the most important one, which is the illiquidity. So you've got, if you're loaning money to a company, you've got let's say a 3-year maturity on a note, and you're expecting to have current income coming off of that over the space of 3 years. In between now and the 3 years, there's no way that you can resell that security. So you're in effect stuck with it. Although hopefully this is a well returning security. So illiquidity, inability to resell. You can't hypothecate against this security. So you're in it to win it, and you're waiting for either the piece of equity that you invested in or somebody to come buy that company, buy your shares in that company, or for the debt to mature off.
Fantastic. Josh, would you like to add?
I would, yeah. I kind of take the opposite position, and there's some benefit to avoiding decision risk, which is typically basic behavioral finance causes us to sell at the worst times and buy at the worst times. So obviously we want as much optionality as possible, and more liquidity is better, but it does mitigate the decision risk for us making knee-jerk reactions and possibly overcorrecting in a position that could be going through some somewhat rocky start.
Absolutely. And I imagine market timing is also quite an important idea to get across to our investor community, isn't it, Josh? Because if you think about what you just said, that when things go bad, the economy takes a downturn, as an example, it affects all industries and other industry-related risk. So from a market timing perspective and risk perspective, to your point around this knee-jerk reaction, well, things are changing, I need to get my money out, it's actually best, or is it best, I should say, to hold this equity or debt security in a private placement, even if the weather isn't exactly sunny and warm outside?
Yeah, I'd say going into an investment, you have your known risks and your unknown risks. a good investment structure will try to mitigate those known risks best as possible. But there will still be unknown risks that could be realized along the way. COVID being a great example. What you need there is a really solid team that you have faith in, either from, let's say an investment bank that's sticking around with the transaction, or the management team in the deal, that they'll be able to roll with those unknown risks and really make the best of a bad situation.
Josh, sticking with you for a moment, when we think about industry-related risks, what other insights do you have in that space?
Yeah, great question. We're always trying to understand what adverse conditions can affect the management team and an investment. We have a deep history in agriculture investing. And so from there, we try to structure transactions around crop insurance policies, which are USDA insurance policies to help farmers in adverse conditions. We can also do some structuring around hedging and such to help with price risk. There are also avian flu, which we just experienced in the Southeast pretty deeply. That's some diligence that we can do and mitigate the risk, ensuring that a facility has separate facilities, raw facility versus a cooked facility. Again, I know that's very specific, but that's the depth that we have to get into to try to understand some of these. Also, we pick our deals after understanding the risk, and I think regulatory risk is a big one as well. If there is an FDA pending result and someone brings us, something that could be the next big drug, we may just say, thank you, but let's wait and see, right? Let's pass for now, stay in touch, and avoid some of those big regulatory risks. Same thing around marijuana. Maybe that's going to be approved in the next 3 years, but raising a lot of capital pending that approval, it just adds a lot of risk that frankly we can't control and we can't mitigate against.
Is it possible, Josh, from your perspective, to know all the risks before getting into a private placement?
If I did, I probably wouldn't be here making this podcast with you, Matt.
Fair point, Josh. Thank you for that. Bruce, I'd love to bring you back into the conversation. A business, as you well know, as Josh does as well, and I'm sure as our investors do know, is that a business is really just a group of people working towards a common goal. However, when it comes to management, not all management teams are as effective as others. So when it comes to understanding risks, Bruce, around private placements, walk us through management risks.
Well, there are, you can take that a number of different directions, Matt. The thing that first comes to mind really is we're working with, and most of these types of investments are with very, very small companies. And you may have somebody who has been, deeply involved in a particular industry from some perspective, not in the management role, who thinks he can run a company. Now, maybe he's good in research, maybe he's good in marketing. Is he good in financial reporting? Who knows? But just think of a company that goes from 3 people to 10 people to 200 people. There you've got a whole set of management risks that maybe this person isn't well suited for. So growth in somebody's company can pose an awful lot of risks, and the company management may not be prepared for it. In certain circumstances, we've had to replace managers of companies just because they couldn't. They were terrific salespeople, for instance, but they simply couldn't run the numbers. They couldn't run the projections, and they were never on budget. So there are a lot of situations like that pose risk in management.
And that's a really great point of departure to talk about offering-related risks, isn't it, Bruce? Because I was talking to a general partner of a venture capital firm recently, and he said he's never seen a projection by a founder, actually meet the realities of the market. It's this idea of the business plan, isn't it? Where no business plan is to buy first contact with the customer. So it's this same idea. But when it comes to offering related risks, Bruce, what does that look like? How does it play out in your world of direct private investments?
Well, you really, again, Matt, you touched on sort of the principal idea. Any of these projections, Josh just talked about the inability to forecast all the issues that are going to come up. Some are adverse economic conditions. Some are agricultural pests that can invade, a farm. But the projections that we work with the company on, we try, and I hope anytime you look at one of these investments, I hope the investment bank or whoever is bringing this to you has also done the same thing. You take your best shot at projecting a realistic scenario, and then I hope the issuer or the investment bank ratchets it back a little bit to protect someone from being so off market that the projections are unrealistic. We've seen a lot of companies where the projections are like a hockey stick, and if you're new to this kind of business, you know that a hockey stick is a graph that shows somebody puttering along at a slow clip, and then all of a sudden it takes off, and he's a multi-billionaire, and he owns an island, or he's building a spaceship. You don't see a lot of those. We've got one company right now that looks like it truly is going to be that way, but most companies go in fits and starts, and that's where you have to, when you're doing your due diligence, you have to have a grain of salt and think through what is a likely scenario. God knows, a lot of these small companies will have a very concentrated customer list. And let's say one customer produces 50% of the revenues for that company. Josh, what happens to that company if they lose 50% of their revenues? It's a terrible situation. So look at things like that. Is their customer list broad, and does any one company have a large portion of, or generate the large portion of the revenues for that company? That's the kind of risk I'm talking about.
Josh, I'd like to bring you back in here in the conversation just to maybe double down on what Bruce described as a potential scenario. And you said it earlier, Josh, where you have the known unknowns and then the unknown unknowns. You know what I'm saying? When it comes to risk management, let's say that the unknown risk manifests in some way. As an example, let's take a pandemic, for example. We didn't all, predict that one happening, yet it did. And so as an investment bank, when you're the custodians of the investor capital, right, that you're putting into a company, if as a worst case scenario, a unknown risk manifests like a pandemic and it impacts the security value or the growth trajectory of a private placement or a company that you guys have facilitated a match with an investor, how do you manage that? How do you, from a post-deal perspective, manage the ongoing transparency and effectiveness of that investment?
Yeah, great question. If an investor invests in a private placement, and I'm, going to exaggerate, but on the back of a napkin, right, without having counsel, without having investment bankers doing diligence at their fingertips, along with structuring an investment to be protective in ways that, again, we can predict, in some ways that we can't, it can get in some pretty hairy situations. If you do have a force majeure event like we just experienced, and you don't have covenants that bring all the investors back to the table when a company is struggling, then really you're not protected, and the company can really just default on their obligations, and you have very little, if any, recourse. What we try to do is, is kind of two sides of the same coin. We put those strict covenants and those strict protections in place for investors, but also we know a force majeure event can't be predicted, and frankly, it can't be solved overnight. So what we'll do is we'll work with the company really hands-on to understand what their next plan is, help them have a plan B, build some real confidence around what that plan B is, understand what the ask from the investor is. We can put a debt security into forbearance, interest only. So, investors are still getting a return, but the principal payments are getting delayed. that gives the company enough breathing room, again, assuming they have a great plan to pivot from whatever the episode is. And, we can monitor that plan and keep them on course, continue to report to investors to give them comfort that that plan is being implemented. Frankly, if it's a undesirable situation, and, it rarely comes to this, but sometimes it does, odds are the company has a lot of shiny new equipment from the financing or a piece of real estate that investor has rights to. And we will go to court, we will go to bat, and we will enforce whatever protections we put, and, make sure that companies get what they deserve and what they're entitled to.
Great. And what I'm hearing, Josh and Bruce, is that even in the worst case scenario, you have your investors back.
Exactly. Yeah.
Perfect. Gentlemen, that concludes your time in the hot seat on the Direct Private Investment Show. I've learned a lot about risks. I know it's a very important conversation to have with an investment community that are looking at private placements. And so, Bruce, thank you for your time. Josh, great to see you again, and we'll see you all again soon.